Welcome to the Matt Laricy Project. This show is about all things real estate, business, marketing, and entrepreneurship. Each show consists of myself, Matt Laricy, and a member of my team, and a guest. This week, the Matt Laricy Group team member joining us today is John Paul Combs.
Combs.
I want to say Combs.
Yeah, you always say Combs.
We also call him the Pope.
Yep.
John Paul, he's a little under the weather today, as he said earlier.
A little bit. He's not under the weather, but
he's fighting some things right now, right?
a little too much wine.
A little bit too much vino last night.
Yeah.
All right, and this episode is episode 18, Hard Money Lending. We have Leigh Ballen, right?
Yes.
Is it Ballen? And
Nailed
like he
it.
said, it looks like Ballen, but it's Ballen.
That's right. People would prefer Ballen.
Yeah.
I'm thinking about a change.
Yeah, I think, you know what, I'm not saying like you have to go about and rename yourself here, but it's pretty badass
It could be good
if it
marketing.
was Ballen. So, and you're with Hard Money Chicago. Tell us about your background. Like, how did you get into this hard money lending and stuff like that?
So I'm a lawyer by background. I was a practicing litigator for 6 years.
Were you like a Senator Woman style, like flip the table over, like you're out of order type stuff?
This whole courtroom's out of order.
Yeah.
No.
No flamethrowers.
We had people for that.
Okay.
We represented actually victims of mass tort accidents. So, the drama kind of spoke for itself. These were plane crashes, and these were people that.
Oh, wow. Okay.
99% of which don't come back. So you're representing the widows, the families.
Okay.
And it was all international work, so I was all over the world doing that. Actually, from the time I was a teenager, I was sent abroad and working in that world till I was 31.
Wow.
Yeah, and then I came from D.C. where our office was, and I moved here in 2001. Started work the day before 9/11.
Wow.
Learning real estate here in Chicago, and so I was a rehabber for 8 or 9 years. And the market, as you know, 2008 speaks for itself in terms of where the market was.
Well, 01 was an amazing market. Like, it was just coming out of like a small recession, and then just like started. That's like hit 02 hit, and that was like 02 to like 06 was like some of the best markets ever.
For sure. All you had to do was buy and sit on it.
Yeah.
I mean, you didn't have to fix it. If you didn't get demoed, you'd make money. So we were in that world buying from the foreclosure auctions downtown,
Yeah.
and flipping and adding value. And if we couldn't make money on that, we would hold it and rent it. So I went through all the iterations of the hundreds of mistakes you make as a rehabber, flipper, developer.
Yeah.
Everything from the wrong legal description on the deed, to failure to record the deed, to
Right.
not getting a survey, to you name it, violations, doing things with and without a permit, and
That was like the whole Rich Dad Poor Dad phase too. Like, remember? Did you read that book back
Sure,
then?
sure.
That was like the biggest like bestseller book.
Yes.
Because like 02, the market gets unbelievable. This guy writes this thing about flipping, and then everybody gets in the game. Everybody's making mistakes left and right because you're figuring out as you go.
Sure. Yeah, it's a famous time in American real estate. Everyone was in it one way or the other.
What made you go from being a big litigation attorney to wanting to get into real estate though? Like, where was the pivot there?
Well, for me, I wanted my widget, and so I didn't know whether it would be real estate or something
Okay.
else, but I wanted to be out of the practice of law. It was something where I did it more to learn a business my father had been in, that I loved working with him, but
Okay.
it wasn't something that I necessarily saw doing for a career.
Wow.
And so
Okay.
by the time I was 31, it was time for me to say, okay, if I'm not going to do this, what's my widget going to be? I wanted a business type thing, and so my father-in-law introduced me to some Chicago real estate guys. And I thought what they were doing was really neat. They were in tough neighborhoods. They were buying houses for $40,000, which appealed to me greatly because I didn't know anything about real estate. So if you're going to buy an asset, that seemed like the right price
Cheap
point.
ticket.
Yeah, and you're 31, 40,000 is not the end of the world, right?
That's right.
We're not talking $4 million
That's
flips
right.
here.
I could
Yeah.
cobble together enough uncles to come up with 40, but
Yeah.
beyond that, it would be challenging. So
Yeah.
my way of learning was to go into the least expensive part of the market and make those mistakes where I could learn.
Right. And then, so you pivoted from there to getting into like the Chicago Bridge Loan, hard money lending Chicago, or how did that evolve from going from flipping to getting to that?
Sure. So 2008, as you know, everything sort of froze.
Best economy of all time.
Yeah, of course. And that continued till 2010, during which, from my point of view, and I think most people were a deer caught in headlights during that time. Couldn't figure out how to make money. There was no credit being extended. And things started to thaw in 2010. So in 2010, someone approached me about a building. I think it was $200,000. And, you can't lose. You're going to put in 20 and you'll sell it for 280. It's a great base hit, whatever you want to call it, nice
Right.
profit. And I said, what if it doesn't work? He said, what are you talking about? You never used to be like that. You could see it, you do it. And I said, I just don't know. I'm gun shy now. This has been a hard time. For
Right.
everyone, it was
Yeah.
hard.
Yeah.
So a guy finally, exasperated, the broker said to me, if you're not going to buy this, I got another guy ready to do it. I said, well, then what are you talking to me for?
Right.
He said, that guy only has $100,000. He has 100,000. He needs the other 100. And I said, what does that have to do with me?
Right.
And he said, he'll pay you 15%. He's only keeping it for 3 months. He doesn't care about the rate. And I said, that's interesting. That I would do. Because I understood the value of the asset. I didn't think he'd lose money. I just didn't know whether he was going to sell it at 280, 260, 250.
Right.
But I knew putting in 100 was a safe bet. And so I did that in 2010. And I thought to myself, well, how much more of this is there? Because I think I'd be good at this. And I think I have access to the capital to do it.
Wow.
And that's how it got started.
So is this just by you? Is there a couple partners involved?
Just me.
Okay.
Yeah.
And so, like, for people out there that maybe don't know, what is hard money lending? Like, what does that even mean? Because you hear about this,
Sure.
and I don't think everybody kind of knows. I think it's like one of those terminology people are like, I know a hard money lender.
hard money.
Yeah.
Sure.
Especially the Pope here. You know what I mean? You know a lot of guys, huh?
Yeah.
No,
Cool.
but like, people hear that terminology, but I don't think anybody knows what it means.
Sure. So bridge loan or hard money loan, people use them interchangeably. Hard money means essentially, I think the phrase comes from it's a hard asset. A guy's looking at this saying, hey, I'm going to put X amount into it because that's some percentage of what it's worth. I'm not too worried. This is the traditional notion of hard
Right.
money. I'm not so worried about the borrower. I'm not so worried about his credit. I'm not so worried about all these things because he's got this box worth $100,000 and I'm giving him 55. It's a hard loan based on the asset.
Got it.
You know, the underwriting is inherently less, or that's the thinking of a hard money loan. But people use hard money loan, bridge loan, somewhat interchangeably.
So like, how's that different from like a traditional mortgage lender? Like, what's the difference?
So, we're mortgage lenders in the sense that we're securing our promissory note by a mortgage.
Yeah, like with an asset, so you're kind of
Yes.
using the property as collateral against
Yes.
them. So if they default, you take the
Yes.
property back, right?
That's right. The distinction perhaps is that when we talk about regular mortgage lenders, we're talking about people that have access to federal funds. The banks, the big banks have that money. They're charging a delta or a spread on their federal funds
Right.
rate versus the marketplace rate, et cetera. We have access to private money, non-federal funds, so we're making our spread on a higher cost of capital. We're not as regulated. We're in Illinois, actually, very little regulation. But we also, it's different structure. They're taking federal funds, they're
Right.
lending it, they're making a spread, and then they're immediately selling that paper or that loan
Out in the open market.
Yeah, it's a very fluid market.
Yeah, I mean, that's
and
that's
they don't
why
sit on it.
the banks kind of had a big problem, is because when the Big Short, the movie out there, was everybody was selling these subprime
Yes.
mortgages, and then
Yes.
they went away, and then everyone went bankrupt. But
Yes.
you talk about regulations. Do you have more restrictions? Because I have to assume the feds are probably mad that there's other people out there making the juice off the interest. Do they come after you guys more or anything like that?
Well, no. I mean, there's a couple different issues. The feds aren't mad one way or the other. They're looking at their funds and they're saying, "Hey, you will lend these only under the guidelines and the auspices of the federal government's rules as to what can be done with this money to protect the greater public." Right?
Yeah.
We're allowing you access to the federal window.
Yeah.
But you're going to lend with certain terms. They're going to have certain credit ratings and they're going to have a certain amount of income ratios that apply to protect us, so that we should get the money back.
Got it.
There's a huge protective system in place because it's a taxpayer money at the end of the day.
Yeah.
And the paper's being sold, it's being marketed, and so it goes into the broader economy, and then it's a securitized instrument. It becomes part of the health of our economy. Private lenders can sort of make any mistake they want, meaning we tend to hold on to the paper. We take the risk for the length of the loan.
Yeah.
So it fills a necessary void, I think, because there's a lot of things banks, if you talk to a banker, they'd say, boy, we would love to do that loan. We can't do it.
Yeah.
So I think it provides an essential service, and it's part of the health of our economy that you have these alternate opportunities or options.
So would you guys consider yourself like mortgage brokers or anything like that, or not really?
Well, we're not brokers. We're direct lenders. We're mortgage lenders, but the big distinction perhaps is that we don't do owner-occupied lending.
Okay.
And this is my firm, right?
Okay.
And I think we're representative of the broader market generally, which is these private lenders. We tend not to be owner-occupied lenders, and there's some regulatory reasons, and also there's philosophical reasons. For me, I could make it work, but I'm not in the business of doing an owner-occupied loan because people in their home, they think it's business, but it's only personal,
Right.
Your home is your home. It's the last bastion of protection for you.
People get a little emotional over these
Sure,
things.
and they
Yeah.
should. And so as business lenders, we're looking at the landlords of the world, the real estate investors of the world, and we're saying, hey, that's who we're lending to.
Yeah.
Somebody that says, I don't live there.
Okay.
I don't work there necessarily every
Right.
day. And if things go sideways, we can sit and talk about how do we resolve this without saying, hey, honey, we're selling the house. This is not the type of lending.
Yeah, so you're not like putting a family out in on the street. You're more or less like taking an investment property maybe back, and these guys are mostly probably business guys, and it's all about the numbers with them rather than
That's
the
right.
emotional component.
That's right.
So, like, you talk about like, you're not outsourcing the money. It's not getting sold in the open market like a lot of traditional brokers do. Who funds these projects? Like, how do you guys get access to this capital? Because obviously, if you're loaning $300,000, $400,000, $500,000, you have to have money coming in. Like, where is this money coming from?
Sure.
Is there a tree outside I could shake to get some of it? Like, I'm curious.
It's taken a lot of years. So for me in particular, my firm, a lot of our money came from lawyers and people that I knew in the business world, which started out as lawyers because that was my background.
Yeah, yeah.
And there were a lot of people that I knew that would want exposure to real estate, but they want someone managing it. And we're the debt part of the equation. So when you talk about the capital stack, my argument is in our initial scenario, the $200,000 and we're lending $100,000.
Yeah.
A lot of people really like the notion of being in that part of the capital stack. We're making less. We're not getting an equity upside, but we're not taking the equity risk either. So there's a lot of people that I've known over the years who like where we are in the stack, so to speak, and say, hey, I would give you money to do that. I'd like a straight return. And so my money over the years has been raised by people who see my track record. The lawyer thing helps, just knowing, coming at it from what are the applicable laws, what are our remedies in the event of a dispute, and then saying I would like to be part of that. But it's like any
So it's
business,
kind of like
takes
a
time.
REIT almost, but like you're not on the real estate aspect, you're more on the loan side. So you're kind of like the house. Like in the house usually wins, kind of.
Yeah,
That's the way I'm looking at it.
we're debt. We're there to say go win. We're a shorter term solution at a higher interest rate, but we'll do the sorts of things that regular lenders can or won't do for you to get there. So it's a temporary remedy, meaning in a real estate perspective. As you know, it's 6-9 months. It's very fast in real estate. So we represent that area where you're saying, hey, I have opportunity here. I own this house. It's finished. It's on the market.
So your guys that are backing these projects, and some of the, not just guys, but probably groups of people who are, given money to be able to have this access to this capital, how often do they, cash out and go away? And then like how much on return are they average making?
So our borrowers?
Yeah, your guys that are loaning the money out. Yeah.
So you're talking about now we're lending to someone, and what are their
Well, I'm talking about more or
expectations?
less like the
The investor side.
Yeah, the investor side.
Sure. So
Yeah.
in my firm, it varies. I would say that a lot of hard money lenders are set up to provide a return as part of a fund, and it fluctuates somewhat with the performance of the fund. I'm not quite set up that way. It's more individual. So I pay a straight rate of interest, and I pay that to the investors based on the amount they have in.
Do you have like an average rate of interest that you guys kind of make back? Is it like a 2 return, 4 return, 6 return?
Well, they're paid more, so they're when they compare us to say a certificate of deposit or other fixed income assets. Let's say it's a tax-free bond they're comparing us to, and it's the municipality of New Jersey or the state government of Tennessee, and they're offering a 4.5 tax-free or 3.8, whatever it is. They're looking at us. So we have to pay higher, so we're paying 8-9% to them.
Wow.
Because they perceive some risk. I argue it's very little, but that's the delta between maybe taking a bond and trusting someone they've known a lot of years. It's all perception of
Well, listen,
risk.
anything above a 7% return on an investment for lending is good return on your money.
Yes.
So,
yes.
what about like finding the other guys? Has it been, now that you've gotten bigger, has it been like hard for you to find other investors to help pool the money in?
It's a 2-horse race. Find more loans, find more money. I don't know that it's been hard. In the early years, it was harder. Having a track record helps.
Yeah.
And we have a very good track record. So
how many loans on average are you guys kind of giving out a year then for that?
I'm a smaller shop. So
Okay.
for us, if we're doing 75, 100 loans, that's maybe a normal year.
Okay.
Yeah.
Okay. So finding maybe, so if you do 75 to 100 loans, how many
Maybe
investors?
150. So
Okay.
if I think about it more, it's maybe 100 a quarter, 150 a year.
Okay. And then so like how many investors do you need to find a year on top of that?
Not that many, a handful. I mean, if I added 2-3 investors a year, it's fine.
Oh, wow. So you have guys that kind of stick around long term with you then?
Yes.
Okay.
Definitely.
And this kind of like just part of their portfolio of what they expect?
Absolutely.
Okay.
Absolutely.
And then how much does it cost to do a hard money loan? Like, what
So
are the
what do we
fees involved?
charge? So
Yeah.
it comes out to, I would say you're going to be in the blended high teens when you really look at what it costs.
Okay.
So the way we look at it is it's a temporary high spike in interest to your portfolio. So,
Yeah.
you're trying to get a 5% loan for whatever reason, that's not happening.
Right.
So you're going to high teens, like a high use price on electricity during
Yeah.
peak hours. You're going to peak hour pricing with the expectation that in 3, 6, 9 months, you're going right back to cheap money.
Yeah.
And so that's where you'll be.
So your average rate would be in the teens then, is what
It
you're saying?
would.
So like 12, 13, 14%?
With fees, when we're really looking at the whole picture, they're looking at higher teens.
Okay.
It's going to cost that, but there's no minimum interest period, so people are looking at it and they're saying, hey, people who make money with hard money look at it as what I might call the chunk price, meaning I'm borrowing $100,000. It's costing me 16% when I add in all the fees. When I really look at the HUD,
Right.
at the closing statement,
Yeah.
what did it really cost me? It's 16%, but I'm using it for 6 months. So it really cost me $8,000. So from an interest rate perspective, it's much higher. From a opportunity cost perspective, it's $8,000 for me to get my 100 to go do that project
Right.
that I otherwise am just not going to get.
So then a twofold follow-up question there then. Do you guys encourage people to take use you guys as leverage to be able to get the opportunity to do the loan and then refinance later, maybe with a traditional bank to get the different rate? Does that happen often?
Well, that's the goal. That's the ideal situation is, hey, you're here on one side
Yeah.
of the bridge. You need to get this project up and running. You're either going to rehab it quickly.
One side of the bridge gets the other bridge.
There you
Bridge
go.
loan,
Yeah,
right?
it's a metaphor.
Yeah, there we go.
So somewhere along the way, you're saying to yourself, okay, I've looked at the bank. They didn't say no to me. They just haven't answered me. Time's a waste, and my seller doesn't like me much anymore. I
Right.
need to get this done.
Yeah, yeah.
I'm now going to double my interest rate for 6 months. What is that costing me?
Yeah.
What is the difference between the bank rate plus fees and our rate plus fees? And they're looking at that and saying, that total number is 5, 10,000, whatever it is. So now I'm making 90 or whatever their profit
Sure.
is going to be, right?
And then the goal is to then refinance, cash
Always.
out, and then
Either refinance or sell.
Okay.
What's that average time from, for one of your clients?
Sure. So the initial term for our loan is 6 months. I would say we end up holding loans on average 9 months.
Oh, okay.
Oh, so it's not like that long of a
Super
time that you
short.
guys
It's
have
Not.
this.
That's why we can look at it more as a spike in interest, where you're, you're using it well for a short period.
Do you see? I mean, in my head, and I could be totally wrong on this, but one of the things I always think about with like hard money lending is like a lot of our developers. Some of them come from different countries and stuff like that. I have to imagine it's hard for them to get loans, and like they see a piece of land they want to develop, and land up until the last couple of years, land's been really hard to get a loan on. In fact, nobody gave loans out on land almost for like from 11 to like 14, it was
That's
like
right.
almost impossible to get a loan on a land, unless
Exactly.
you had like millions upon millions in the bank. And as we talked about, everybody kind of came out of the recession broke. So,
Right.
And then they want that opportunity to be able to develop and build on it. Is that a big market you guys see a lot? Like, do you guys loan in that
Ground
aspect?
up new construction?
Yeah.
It's not as much our specialty.
Okay. Do people do it in Harlem? I'm just
Oh,
curious.
yes,
Yeah.
absolutely.
Okay.
Yeah.
So you guys more like the multi-unit type facet and stuff like that?
It's not so much that. I'm not for true ground up. There's another firm in Chicago, and I'll use their name because they're wonderful, Renovo.
Okay.
Is really, really good at that.
Okay.
And so if you're ground up, they're more sophisticated when it comes to that. They have in-house inspections. They're really driven to be those sort of new construction lenders. They're very
that's kinda like their
sophisticated
niche.
with it.
Yeah.
I would say so. I mean, they can do anything. They're a bigger shop,
Yeah.
but that's something they're very good at because the amount of inspection involved when you're putting in foundations and sewer and water and the percentage of construction, it's more complicated, the numbers are bigger, and it's more of a specialty market to do that. Mine tend to be more one-off, two-off. I have a house, it's finished. I have a second house, it's finished. I found my next house down the block. I have to buy that. I was so sure one of these was going to sell.
Right.
Right? But I just need the money to buy that house and maybe start construction. And then when one of these sells, I'm taking you out.
So you're more like the rehabbers.
I
instead of
tend
ground
to.
up.
It just happens to be who's drawn to me, or guys in flux who can call me and say, "Hey, you know me. I'm in flux. Here's what I need." And I understand it. I was a rehabber, builder. We have a very common conversation about what has to happen.
So one of the biggest things that a lot of people, because I remember when I was, I got in the business in 06, and I took the company downtown in 08 and tried starting a real estate company then, which was not my favorite memories.
Hard time.
Yeah, but one of the things I remember, and I asked my old man who's been doing this for 40-something years, is I was always like, how did everybody go so broke when the bubble burst? Like, how did all these people with real estate go so broke? And it was one of those things exactly, it's almost comparing to like a restaurant or something like that. Everybody had all their money in all this real estate, and they were leveraging the real estate assets to get more real estate. And that's kind of like what you're talking about here, is that they couldn't sell the 2 homes. So they leveraged those homes to get another loan for a third one. And maybe the economy wasn't doing as good then. So now with the economy starting to kind of soften a little bit, are you nervous for these people to have these assets maybe kind of default more often on it?
I mean, you're right. There's a benefit, right, to having been through the '08 cycle. So, we've constantly drawn those comparisons.
Yeah.
2 things. One is when
I'm always scared. You know what I mean? I'm still scared,
Well, it's good to be that way.
Yeah.
I think that's the healthy way to be in real estate.
Yeah.
Caution the person who thinks they only win in this business.
Yeah.
That's the type of person I don't want to lend to, because
Yeah.
they don't understand how you can make mistakes. If you aren't making mistakes, you're not very good at this business. If you haven't had
the
a
people who
budget
got in
overrun.
now. Yeah, like,
sure.
the people who got in now, like I talked about this in our business in real estate, like all these people who got in like 16, 17, like, fuck, man, selling real estate's the easiest thing in the world. There's buyers and
Right.
sellers all over the place.
Right.
I'm like, dude, like these last 3 years have been like the best years ever since, 5, 6, 7, you know?
Yes.
So like, I
Yes.
remember 8. So like, I'm more like, afraid to touch the hot stove, them to get burned again. And these guys are like just kind of going in. So
Yes.
are you seeing a lot of developers that are kind of fearless like that?
Well, this is the time now where you're starting to see that,
Yeah.
right? But anyone who was around the first time has a certain amount of cautious protection in their own DNA now, right?
Yeah.
You don't make those same, you hope that you're not making the same mistakes as '08.
Yeah.
The people that weren't in that cycle that are newer to this are more dangerous in my mind.
Yeah.
Because you have to once bitten, twice shy and that kind of thing.
Yeah, yeah.
So I'm not seeing that it's anywhere near '08. Remember, in '08, there were lots of people by '06, '07 going, I can't believe
Yeah.
the prices of real estate.
Yeah.
We're seeing that in hot areas, but we're not. It isn't the talk on every corner. It isn't the Big Short, that crazy sense of real estate was everywhere, right?
Yeah.
I mean, that dynamic was like the way people talk about IPOs today,
Yeah.
or, choose your topic.
Yeah, yeah.
It was the hottest thing. It was like bubbling over. And there were a lot of people saying this is a bubble. That word is used only to try to compare to '08. And it doesn't feel, and I'm using that in quotations because I'm
Yeah.
not an economist, but it doesn't feel so overblown. It feels harder to make money. So I'm seeing more harder to make money.
Yeah, I see that too.
People overpaying a little on the buy side because they make mistakes like wanting to keep their crews busy. So the
Right.
the '08ers, if you want to call them that,
Yeah.
don't do things like trying to
I
keep
like
their
that terminology.
crews.
'08ers.
Yeah.
They
Yeah.
don't. Those folks won't buy a house just to keep their crew
Yeah.
busy. That type of thinking has gone away. You don't need a crew if you're not going to make money. To step back and say, hey, it's okay to do nothing right now, and that's I think a strength in real estate, knowing when to just do nothing.
Yeah, I mean, I think I don't see us going towards like this big bubble like a lot of people think, because it's not like you said, where you're scratching your head like, that's sold for what? Like, how did that happen? Like, that doesn't even make sense.
That's right.
Like I kind of feel that way a little bit in the rental market right now. Like they're building how many more buildings, for rents? Like,
Sure.
I mean, I kind of feel a little bit like that. But when it comes to the sales, I mean, even now, I mean, the market's still really strong, but everybody's like, talking about, all everybody talks about in our industry is the year of the shift, how we're shifting towards a buyer's market. I personally just think we're shifting towards a normal market, because, we were kind of, a little bit nervous because we're the '08ers, so like we're still cautious. And then you got the new people who, so we know the worst market ever, and then lately we've had the best market ever, and people think it's either going to be one or the other, but I think we're just shifting towards a normal market. I think we're shifting towards things aren't going to sell in 24 hours. I think people are going to have to work a little bit harder. Dealers are going to have to get a little bit more creative. Buyers, sellers aren't going to have a leg up on each other. I think we're going to go to kind of like a less transactions for about a year or so when the recession hits. But kind of talking about like these people, you're seeing this firsthand, these guys who could be overextending themselves. Do you ever tell them like, hey, listen, I'll give you a loan, but like, I don't know if this is the best move for you? Do you ever like see that happen, or do you ever try to coach these guys?
I talk people out of things all the time,
Yeah.
such as just don't buy that next house, or maybe you should wait.
Is that more often than not? Like, how often do you turn people away?
For that particular reason, where they would easily qualify for a loan, but I tell them not to. Not that exact situation, but you see a lot of people overpaying.
Yeah.
And so I'll say to someone, okay, look, you want to pay $1 million for this house. You're not making enough money for us to do the loan. And they
Yeah.
say, well, what do you think I ought to pay? And I say, listen, it's not for me to say, but if your base is going to be $1 million and you're putting in like 150, let's say it's a medium rehab, it's not a heavy rehab.
Yeah.
Your basis is $1,150,000. You're in too high. And what should I do? I say, if you want my opinion, you need to go back at $900,000. They're never going to sell it at $900,000. Say, that's okay.
Yeah.
But understand that I think your base is too high. You're not making enough money.
Right.
Don't do this.
Right.
Because we don't want a scenario where everyone's making money. the appraiser, the lender, the broker, and it's a giant dance around the owner who's not going to make anything. It's unhealthy, and it leads to them not wanting to show up for work. And so it's not that we're so altruistic, but they need to have enough profit at the end of the day where they can work hard towards something that they reasonably should expect to make real money on.
Right.
And, as your profit is approaching zero, you go, gosh, what should I do instead to make money right now because I have to feed my family? So we look at the whole picture and say, hey, you're just not going to make enough. And for that reason, just don't do this deal.
So how do you do those evaluations? And like what's the numbers that, like the formula you use to be like, okay, we'll give these guys a loan or we won't give them a loan? Because obviously you don't want them to default,
Right.
So how do you come up with this? What are the numbers you use to come up with whether it's a smart move for your company or not?
So, the first step is usually the borrower themselves. They usually are pretty sharp as to what the property should reasonably sell for. A lot of times they underestimate their construction budget.
Yeah.
That's a bigger and different problem. But what it's worth when they're done, they're usually pretty close. And then I check those numbers with a broker who might know the area.
Yeah.
So I might be calling you one day and say, hey, look, this is what they want to do.
Yeah.
Our house is really selling for $850 over there. Do you like that area? And say, ooh, I don't know. That's north of this and west of this. We don't see comps there. Are they doing this and this? And I say no. And you say, I don't love those numbers. I'm looking to what the lower end of what it's going to be worth. That higher end is for them.
Yeah.
I need to underwrite it to the lower end. So, they're telling me it's worth 700 finished, and my intel is saying 625. I want to lend off that 625. I'm not in a position to lend off the 7 because that's what I hope they get.
Right.
But as underwriters, we're looking to the low end of reasonable and then taking a percentage of that, which is usually about 60%.
So you bet a lot on the jockey.
You have to.
And personalities and things, somebody that you believe that's going to get the product, delivered. And then you kind of consult with another professional to see if it aligns and it seems realistic what the result's going to be.
Yes,
right?
I'm pretty fortunate now to have somebody I can call for a lot of bigger neighborhoods and say, hey, what do you think of this? And they have, as you guys know, you end up specializing or getting really smart in a given neighborhood.
Sure.
And the minute I say an address, say, oh yeah, I know that building. I sold one down the block. I did this. And then you just see the data points popping up in both of our heads going, okay, and then wait, what did they want to sell this for when they're done? Say, I can see that, but it better be gorgeous. Let me show you what we just sold.
Right.
And so you begin to build this matrix of what it should reasonably do, and then it goes back to what you were saying, which is this the person to do that?
Yeah. I mean, I think a lot of is seeing the patterns in the marketplace. So understanding where things are going to go, being a step ahead. And, I think some people, like you said, may kind of overshoot a little bit, and those probably aren't the people you want to get in bed with because it's probably going to have a problem. So, is there certain people that right off the bat is a no-go for you guys? Is there something you see automatically nope, that's something we don't touch at all?
Well, yes. So we see owner-occupied things being dressed as not owner-occupied, such as we own it in an LLC, but we live there.
Okay.
Right? We're not looking for the wink and a nod so that I can get my paperwork signed off.
Right.
It's the opposite. It's, hey, you really do live there. You own it in a corporate name, but you live there. Mm-hmm. So the mentality for you will not be an investor's mentality. You live there. And we don't want anything that even seems like that. So they own it, but their son lives there. That's the same no for us because it's an emotional thing, and it should be.
Yeah.
But it's not. They're not really going to approach it as investors. And same on the commercial side. If you have a single tenant commercial, let's say you're a hardwood installer, and the shop is full of hardwood, and the front counter has people selling hardwood and installation, we don't want those single tenant commercials either because that's the financial equivalent of owner-occupied.
Right.
If,
So what going off of that stuff too, and who you bet on and things like that, it's a really strong economy right now, and and this is something that I don't know, but is hard money lending better in good markets because a lot of people have money, or is it better in bad markets when people don't have money?
Better for whom?
For somebody like yourself.
I would say an
your company
upswing
was.
economy is ideal for real estate for pretty much everybody because it hides mistakes. If you recall in 04, 05, 06, any mistake you made, you under budgeted. You never were going to replace the windows, and now you're like, oh man, we better do the windows, right? Or we weren't going to finish the basement, but what the heck, we decided to dig it down, right? Any of those construction overruns were covered up by an upswing market because you thought the house was worth 300, you overspent by 30, but guess what? It was worth 50 more. So these upswing markets, they make for bad business practices, but they're very good for real estate investors because your budget overruns tend to get covered.
See, I was thinking it would be, personally, I thought it could be the opposite, right? Because and the reason why is because if the economy is worse, banks kind of tighten up a little bit and they're not giving out money.
Yeah.
And like I always believe that you don't get rich in good markets, you get rich in bad markets. So like
Yes.
these guys maybe see a lot more opportunity to get into buying property when the market's shitty.
Mm-hmm.
So maybe they're trying to, and banks won't give them as much capital, especially because banks never, well, I shouldn't say never. It's really tough to get investment loans on land and I know you don't do new construction, but like land or, multi-unit buildings when, we're in a recession or something like that.
Right.
So I would think like they're going to come to you more often because you could be more or less the only option to these guys because they're
Right.
definitely 100% aren't going to get something from the bank.
Well, I think, you could look at it either way. From our perspective, we want to make sure that the money's coming back. Any money
Sure.
we lend is coming back. So on an increasing market, on an improving market,
Yeah.
that's the most likely scenario to get the money back. On a declining market, right,
Yeah.
it's an evolution. If you're buying, if it's, the market was at 10 and they're buying at 8 because they think it's sexy, but it's going to 5.5, 8 might be a good number. But if it's going to 5.5 for us to lend on a declining market, it's like catching a falling knife kind of thing where it's not as desirable for us to be doing that.
Yeah, because you get stuck with this. So how often do you default on these loans?
Our default rate's extremely low, but we're very liberal in terms of what we consider a default. If somebody goes past the initial term, but they finish the property and
Yeah.
it's on the market, we're not invoking default clauses. As long as they're performing and working hard, the technical maturity date isn't necessarily for us so important as long as they perform. So let's say it was a 6-month initial term, they wanted to extend it to a year, and at a year it's finished, it's on the market, but the contract blew up once or twice, as you know.
Yeah,
You
happens.
just don't know.
Yeah.
Those kinds of technical defaults, we don't really count as a default. So in that sense, as long as people are performing, we don't consider it a default. So ours is extremely low. It's only when they're not performing and the loan to value's gotten too high. So we have an extremely low default rate.
How
in that
how
sense.
often has people not paid the interest and just like you've never heard from again?
And not heard from them? Almost never.
Okay.
Yeah.
I'm just curious, like, you know what I mean? Like,
Someone just completely
yeah, just like
disappears.
ghosts them.
Yeah.
You're even sending Snapchats to this guy, like, hey, give me my money, man.
where you at?
I kind of see it like, you ever watch Family Guy? Like, Stewie,
Yeah,
he's like,
sure.
give me my money, man. Give me my money. Like,
Right.
does that happen often?
Not really. I mean, if we've done our job, we're lending 60% of value. So it's
Yeah.
not a smart business move to just not answer the phone because they left a lot of money in this asset. There's
Yeah.
some people that will lend 85% of value, and I would assume that happens more often once the borrower perceives, right?
Yeah.
I don't have anything left in this. I better go do something else to make money today.
Yeah.
I would assume they stop picking up the phone. But
Yeah.
if I've done my job right,
Yeah.
we've lent 60 cents on the dollar. There's 40 cents sitting there for every dollar.
Yeah.
It wouldn't be smart not to pick up the phone.
Right.
So what about, and then kind of going off of that then, which is like what happens if the economy gets really bad and you get a lot of defaults and you're stuck with all these assets? Like I'm assuming you don't want to be in the real estate business of owning all these
Right.
properties. What happens then?
Well, I have to be prepared to take back an asset, finish it, and sell it.
Okay.
So we have to always lend on something that we wouldn't mind owning. That's why I don't really do certain types of assets. I just stay away from because we couldn't on the commercial side. We
Right.
don't know how to run them. Assisted living. I wouldn't know what to do.
Got
various
it.
certain things. So, but we need to be prepared to. I've had to have stuff handed back to me. I've had
Yeah.
a couple borrowers say, "I just can't perform."
Yeah.
So, what are you going to do? You're going to sue me? What? I said, no, just hand the asset back. I mean, this is part of a workout, right? Conditions vary depending on what we think they did or didn't do.
Right.
But a lot of times we just get, not a lot, I would say in maybe 5 or 6 instances out of 500 loans, we've had probably 4 or 5 people say, hey, take it back.
Wow.
I know where I'm at. I know I should have finished. I didn't.
Yeah.
I'm out of gumption to finish this.
Right.
Just take it.
Yeah.
And
Like,
we've-
no,
and we
I don't
have
want
to- Right. Yeah, but
No, you take it.
we're in the business of having to
Yeah.
do it.
Yeah.
And so once
No.
we see they've run out of, that energy,
Right.
and then that's bad.
Yeah,
and
when the
so
lights
we
out of
had
their
to-
eyes, they're like,
yeah,
yeah.
they don't see it anymore, or their LTV has pushed up. Now
Yeah.
they're in the 80s and they're going, how much am I really making? And I have a day job or whatever
Yeah.
it is. And so that
So-
happens.
So, going off of that, where do you go from here? Like, where do you see the business going? Like, do you want to keep growing it, or do you want to kind of keep small in the boutique sector, or what do you think?
It's funny. My New York investors, I have some friends in New York, and it's all about growth there. Right?
Yeah.
If you're not growing, you're
Expansion,
dying.
right? That's why
Expansion. Grow.
Expansion, always
And
expansion.
so, we're more like treasure hunters. Like how much treasure is buried under the sea. We want to do all good loans. So I don't have a crystal ball for how big it gets. And the New Yorkers hate this answer because
Right.
it's like, what do you mean? You got to grow to two times your AUM,
Right.
and then meet us in the Hamptons.
Yeah.
Well, that's not-
Yeah, where do you summer?
yeah,
Like-
we're in summer. Like Michigan, man.
Yeah.
So we're not. For us, it's not a growth target so much as my theory is to do every good loan.
Got it.
Because I don't like the model of, hey, I've hired a guy and he needs to put, or woman, whomever we're putting in a position, they have to put a certain amount of money out there, or
Right.
they have targets. I don't like the target modality. I don't like the notion of I have to hit a target, because I think it inherently pushes you to make mediocre decisions, or wink and a nod.
Right.
You know?
So, all right. Well, how about social media? Do you use social media at all to gain the company's exposure or anything like that?
I personally don't, because I spend a lot more time out in the field talking to people.
Yeah.
And I feel that for me, the one-on-one of the in-person thing, it could be generational, but
Yeah.
for me, the more people meet me and go, hey, you know what? I never thought of using hard money, but I really like this guy and I like the input I get from him.
Yeah.
I don't know how to share that other than to have friends and brokers tell other people, you should call this guy.
Yeah.
He was super helpful. It's not about doing a loan for you. It's like, hey, what are you doing again? Oh, you should talk to this guy. And the way I think all good professionals are is, what can I do to lift us all up? I'm
Yeah.
not here to how much money can I put out?
Well, I mean, I think if you guys did like hyper-targeted ads on like social media in the areas that you lend in,
Yeah.
like I feel like you guys would crush it.
Oh, I'm sure I'm wrong on this, by the
Yeah.
way. I appreciate you
Yeah.
saying that. There's no way that anybody, with the marketing sense is going to be like, oh, yeah, he's got that straight. He should do no social media. Like, that's
I
an
was thinking
incorrect
about
answer.
this though, like because like if you had like strong, like really good reviews on like Yelp and that stuff, and you did like really cool hyper-targeted ads, like I never seen anybody that does that. So when I was actually on Facebook yesterday, and I got one of these ads from one of the mortgage companies in my feed come in. I was like, man, I was writing the questions. I'm like, what the fuck? Like that'd be like a genius idea for you. So just
Yeah.
throwing dirt at the
No,
wall.
it's worth it. It's worth it to
just
look
some
at.
ideas. So,
Sure.
But we have something where the co-host asks what we call the Fast Five, where it's 5 quick questions. John Paul, what do we got here?
All right. So what's the best piece of advice you've ever received
From anyone?
from anybody?
Anyone.
Anything, anyone.
Oh, that's got to be my parents. My parents, they both say to me, don't kid yourself. So I find that to be a great litmus test of everything I do.
Yeah.
Did you really try your hardest? Well, this notion, I did my best. Think about that for a minute. Think
Yeah.
about high school sports when you tried your hardest, when you were crawling off the mat or
Yeah.
off the athletic field. That was your hardest.
Yeah.
So this notion of not kidding myself really helps me.
That makes sense.
Do you love to win or hate to lose?
My favorite question.
I think everybody wants to hear hate to lose, but I'm a love to win kind of guy. I like to think I can lift all boats, and so if I'm winning, I feel like other people are winning.
Nice.
Very positive answer, by the way.
Who's your biggest hero?
My father.
Good answer. If you could have one superpower, what would it be?
Traditional superpower?
Traditional
Could be any
superpower.
superpower. It's a superpower.
They're
Yeah,
split.
anything.
Part of me, I'd like to just fly. I'd like to get on one of these 4-story buildings by your office and jump off and make it.
Yeah.
But if not that, I'd like to be able to walk into a bar or restaurant and know everything that's going on. I want to
Ooh.
know the
Like
swing.
a spidey sense?
Like a spidey sense.
Yeah.
Like the hostess, she's not sure whether to quit or steal the money she just saw laid down. That swinging door into the kitchen is about to
That's
fall
cool.
off and hit somebody. I want to know everything.
That's
I want to
actually
know.
pretty. That's
good.
I kind of like that. That's a pretty good thing to have. Yeah.
I would love to be able to know that.
So last one. What makes you Chicago?
I moved here 18 years ago, and when I first moved here, I thought about that a lot. Boy, I'm not from here. Everybody could tell I'm from the East Coast. I have that sort of something about me. But now I've gotten the chance to really see, all 77 neighborhoods and work with people. And this town's love for itself is super contagious. So now I know that I'm a lover of Chicago because I can't help but tell other people. I'm like,
Yeah.
oh, you're coming to Chicago?
Yeah.
Like we all do now. Hey, oh, you're coming? Oh, you got to go here. You got to go there.
Right.
We have so much
Immediately a tour guide.
You're immediately a tour guide.
Yeah.
That doesn't happen. You go to New York, it's like, hey, good luck.
Yeah.
Right?
Like, see you later, dude.
See you later, dude. Get out of my way. I
Yeah.
gotta go.
Yeah.
But I find that I have that bug now where I have to tell everybody else, oh man, you're going here, you gotta go there, you gotta try
Right.
this. And I wanna know, did they
you're, like,
enjoy
excited
Chicago?
for it, you
I'm
know?
super excited. And
Yeah.
I wanna know, did they
Yeah.
love it? Because
Yeah.
they've gotta love it,
Yeah.
otherwise they're not seeing it.
Yeah,
So
exactly.
I think that now that I have the bug, that's how I would answer that.
That's awesome.
Nice.
Where can people find you? What would you want to plug?
Sure, they can go to chicagobridgeloan.com or Chicago Hard Money. Just find the number on there and call us. The easiest way to get started with us is to send an email and just put the basics in there. And a
Got
number
it.
where we can call you, or just call us up and say, hey, here's what I've got. And we're here to just talk about it.
Nice. Well, make sure to tune in our next episode and subscribe to our podcast. Thanks for listening to the Matt Laricy Project.